Welcome to the Train Me Today PHR/SPHR Exam Prep Lecture on Demand. Part 1 is from the HR Body of Knowledge, Business Management and Strategy. Please note that if you are preparing to take the SPHR exam, this section is about 1/3 of your exam. For those planning to take the PHR exam, it is about 11% of the exam. This is probably the first time listening to the Train Me Today PHR/SPHR Exam Prep Lectures. Please keep in mind that these lectures are in no way a substitute for your reading of the material. They are designed to remind you of key terms and concepts to help your learning stick. It is still imperative that you read from your HRCP books. Human resource management plays a central role in creating healthy organizations and helping them survive. In the early 20th century, only a few large companies had social welfare departments, and their responsibilities focused mostly on caring for injured employees or their families. Personnel departments, as they were then called, first appeared in significant numbers during the 1940s because of the National Labor Relations Act of 1935. Early personnel departments were primarily responsible for employee selection, training, record keeping, and collective bargaining. These are all still important today, with the most significant change being a growing recognition that human resource departments are expected to add value to the profitability and purpose of the company. Human resources plays an important role in corporate governance. Corporate governance refers to the systems by which an organization is administered, directed, and controlled. We look at things like compliance, integrity and ethical behavior, rights and responsibilities, interests of stakeholders, all stakeholders, and oversight and control. Consequently, in many progressive companies, human resource management assumes a central role by participating in strategic planning and acting as change masters who clarify the organization's culture and help it adapt to an ever-changing environment. So let's take a look at the role that HR plays in an organization. HR is responsible for the diverse issues associated with people in organizations. HR participates as a partner in the organization's strategic planning process by gathering and interpreting information regarding the workforce availability and the business environment. HR acts as change masters who clarify the organization's culture and help it adapt to an ever-changing environment. An organization's strategy determines the direction it will go and serves to coalesce the energies of many people and departments in a unified effort. In a business organization, strategy is about profit. It explains how the firm plans to make money now and in the future. Strategy is about winning and succeeding. Good strategies help organizational leaders make consistent and effective decisions, communicate expectations, coordinate the actions of the members, and helps the organization remain profitable and continue to grow. The major HR functions include staffing, performance evaluations, compensation and benefits, training and development, employee relations, safety, health and security, and HR research. Our discussion question is, how do human resource functions contribute to the strategic alignment of a company? If you think about it logically for a moment, no organization could possibly meet its strategic goals without HR. All human resource functions play a role in the strategic alignment of a company. However, some functions have a greater impact than others. For example, a profit-sharing program provides an excellent illustration of an HR function that has an enormous impact on the behavior of employees and the success of a company. Companies that design and announce a profit-sharing program often discover that the culture of the company changes almost overnight as employees realize that their financial rewards are tied to the financial success of the company. Human resource policies guide the actions of an organization toward the achievement of its objectives. Human resource policies refer to standing plans that furnish broad guidelines and direct the thinking of managers about human resource issues. The most important purpose of an employee handbook is that it provides a central information source explaining what employees need to know about their employment relationship. In other words, what the company expects from them and what they can expect from the company. An organization chart for a company that is organized by function is called a functional organization chart. The Human Resource Department is headed by the Vice President, who reports to the President or Chief Executive Officer, just like the departments of Finance, Sales, and Manufacturing. Most human resource departments are led by a person with the title of Human Resource Vice President or Director of Human Resources. Senior HR executives are usually human resource generalists who possess a broad comprehension of all the HR functions and how they interact with other departments in the organization. Professional and technical people who have special expertise in one functional area, such as staffing, compensation, employee relations, or training, are called human resource specialists. Dave Ulrich, a professor at the University of Michigan's Ross School of Business, has developed a useful 2x2 model for examining HR's role that is derived from two central issues: a focus on processes versus people, and a focus on future strategic issues versus day-to-day operational issues. Ulrich identifies 4 central HR roles from these two dimensions. Role number 1, management of the firm infrastructure. This HR role requires HR managers to design and deliver efficient HR processes for staffing, training, appraising, rewarding, promoting, and managing the flow of employees through the organization. Role number 2 is the management of employee contributions. This HR role requires HR leaders to represent and defend employees and respond to their needs. The purpose of this role is to increase employee commitment and competence. Role number 3, management of strategic HR. This HR role requires HR managers to interact with other leaders in their organization in aligning HR functions with business strategies. And role number 4, management of transformational change. This HR role requires HR managers to help the organization respond to an ever-changing environment, which may involve smaller transitional changes, such as revising a company's evaluation and reward systems, or more substantial transformational changes, such as creating a customer-oriented culture. Dave Ulrich and the RBL Group continuously monitor human resource competencies. The most recent update provided competency and performance ratings of more than 4,000 human resource professionals. The study identified 3 core competencies: strategic positioners, credible activists, and paradox navigator. The study also identified 6 enabling competencies. 3 of these enablers focus on building a strategic organization: culture and change champion, human capital curator, and total reward steward. The other 3 enablers focus on tactical delivery: technology and media integrator, analytics designer and interpreter, and compliance manager. To delve into this more deeply, and if you are studying for the SPHR exam, type Dave Ulrich HRCS model into your search engine and listen to Dave himself talk about the HRCS model. The Society for Human Resource Management developed a competency model that identifies the knowledge and behaviors expected of HR professionals. The 9 competencies seem to describe successful HR professionals internationally as well as in the U.S. They are human resource technical expertise and practice, relationship management, consultation, organizational leadership and navigation, communication, global and cultural effectiveness, ethical practice, critical evaluation, and business acumen. One of the common complaints of executives is that human resource people do not understand the business. They do not know what is required to make a profit or how to speak the language of business. Knowing financial and accounting terminology is critical for successful HR practitioners. Let's look at basic terminology from the International Accounting Standards Board. Terms HR practitioners should know relating to financial position include asset, liability, and equity. Terms relating to the performance of the organization include income and expense. A financial statement is an official formal record of an organization's financial activities. They are used to guide financial decisions based on past performance. The balance sheet is a statement of financial position that reports a company's assets, liability, and equity as of a specific point in time, such as the end of the company's fiscal year. An income statement, also known as a profit and loss statement, reports a company's income, expenses, and profits over a certain period of time. A cash flow statement reports the flow of cash in and out of the company, showing changes in the balance sheet and how these changes affect the availability of cash. A budget is a plan that describes the expected income and expenses over a period of time. Zero-based budgeting requires justification for all expenses in a new budget. HR managers are expected to interact with other leaders in their organization in developing the organization's competitive advantage and aligning HR functions with business strategies. Organizations operate in a dynamic environment. External and internal forces are continually changing. HR managers serve as strategic partners with other corporate executives in executing strategy. An organization is formed when someone has a vision or idea about what kind of product or service the company ought to provide, and this becomes the firm's mission. A vision statement describes the future of the company as a successful organization. Good vision statements answer this question. If the organization were to achieve all of its strategic goals, what would it look like 10 or 20 years from now? An effective vision statement creates a mental image of what the organization will be like in the future as it succeeds. An effective organization begins with a mission that identifies what it is striving to become and a strategy that explains how it plans to succeed. A mission statement explains the essence of an organization, why it exists, what it wants to be, who it serves, and why it should continue. The generic strategy of an organization is driven by the organization's mission, and it includes action plans that will allow that mission to be met. The generic strategy is the game plan that, when followed, will lead to the accomplishment of the mission. The mission identifies the organization's reason for being. It is a shared vision of what the organization is all about. Mission statements are carefully constructed affirmations that outline the organization's purpose. They are usually created using the input of members of the organization. Mission statements, when properly constructed and used, can unify the members of the organization with a common purpose which drives accomplishment of the mission. A mission statement is based on the organization's assumptions about its purpose, its values, its distinctive competencies, and its place in the world. The elements usually found in most carefully crafted mission statements are a purpose statement, the business statement, and value statements. Strategy involves the combination of goals and plans to achieve competitive advantage and the methods of implementing them. Organizations create generic strategies to help them succeed in a dynamic and competitive environment. These generic strategies share several important characteristics. They promote the mission and goals the organization is striving to achieve. They have a long-term focus that extends beyond the immediate time horizon. They define the action plans the organization intends to follow to achieve its mission and goals. And they recognize explicitly the impact of the external environment, especially the reactions of competitors. The goal of strategy is to find an environment where a company has imperfect competition. An example of imperfect competition is Walmart. You ask, why? There are dozens of big box stores. Walmart's competitive strategy / advantage is sustainable because of its geographic monopoly. It entered areas where others didn't want to build and then gained a natural monopoly, making it not worthwhile for others to enter that area, and of course, their operational efficiencies. Michael Porter's 3 grand strategies to maintain a competitive edge are cost leadership, differentiation, and focus. Raymond Miles and Charles Snow developed a typology of business strategies based on the idea that managers seek to formulate strategies that will be most closely aligned with their internal organizational characteristics and the external environment. They identify 4 strategies: prospector, defender, analyzer, and reactor. Human resource activities play an important role in the value chain. A firm's value chain consists of 9 generic activities. These 9 activities include 5 primary and 4 support activities. The primary activities are inbound logistics, operations, outbound logistics, marketing and sales, and service. Support activities are firm infrastructure, HR management, technology, and procurement. Strategy formulation is not a systematic process that advances sequentially from one action plan or objective to another, although it is less chaotic in some organizations than in others. Strategy formulation is a dynamic process that is evolutionary in nature and subject to change as external forces change. Since strategy focuses on the future and the future is uncertain, strategy needs to be flexible and ready to respond to revised conditions. A popular approach to strategy development is often called the SWOT method, which stands for strengths, weaknesses, opportunities, and threats. Decision makers should examine the organization's competitive advantages relative to its internal strengths and weaknesses, its external opportunities and threats, and potential competitor actions. For organizations to be effective, all of the human resource functions and other business operations need to be coordinated in ways that support each other. This coordination is called strategic alignment. Organizational capabilities explains how human resource practices contribute to a firm's business strategy and refers to what the organization is able to do with the collection of skills, talents, technology, training, and experience possessed by the members of the firm. To survive in a dynamic environment, organizations must be prepared to diagnose their opportunities and revise their strategies. Choosing the right strategy usually makes the difference between success or failure. Good strategies depend on good alignment and implementation. New strategies require corresponding changes throughout the organization. To make organizations more effective, the mission and strategy must be aligned with 4 organizational characteristics: structure, systems, culture, and processes. Structure is the fixed relationship of the organization, such as how jobs are assigned to departments, who reports to whom, and how the jobs in the departments are arranged in an organizational chart. Systems are the patterned activities that keep an organization operating. The strategy of the corporation must be aligned with the strategies of each business unit, which in turn should be aligned with the functional strategies of each subsystem. Culture is the system of shared values and beliefs that influence worker behavior. And processes are the interactions among members of the organization. Internal conditions also play a major role in strategy formulation and implementation. Under the resource-based theory of the firm has a sustained competitive advantage resulting from the ownership and control of resources that are rare, non-tradable, non-substitutable, valued by the market, and difficult or impossible to imitate. Such resources include physical assets, intangible resources, and organizational capabilities. Some organizations are able to achieve a sustained competitive advantage and earn above average profits because they possess unique resources or they have capabilities that provide a competitive edge and cannot be easily imitated. These resources are often categorized into human resources, physical resources, and organizational capital resources. We live in a global economy requiring global companies to perform an industry analysis and think seriously about the strategies required to sustain their competitive advantage. The Industrial Organization Model, or IO model, suggests that the conditions and characteristics of the external environment are the primary determinants of successful strategies that will help firms earn above average profits. Michael Porter's 5 forces model of competition identifies the major environmental forces of an industry analysis. This 5 forces model suggests that an industry's profit potential is a function of the interactions among these 5 forces. Organizations can use this analysis to examine an industry's profit potential and to establish a defensible competitive position. given the industry's structural characteristics. The 5 forces are suppliers, buyers, rival firms, product substitutes, and the threat of new entrants. Successful companies perform a competitor analysis for each competing firm in their industry. They look at future objectives, current strategies, assumptions, and capabilities. After a company has formulated a strategy for how it plans to compete successfully within its industry, it needs to prepare a business plan to help it acquire the needed resources. Okay, let's move on to HR control and evaluation. To begin, we need to look at budgets. A budget is an itemized estimate of the operating results of a company for a future time period. Budgets have 3 major purposes. Let's start with coordination and integration. The budgeting process requires establishing objectives in advance and identifying the steps by which they will be accomplished. Motivation. The budgeting process involves goal setting and feedback, and these activities serve to increase motivation. Control and evaluation. A budget is an important management tool for monitoring the performance of a business unit and controlling its actions. HR activities should contribute to the financial success of an organization. Some of these measures focus on evaluating specific HR activities, some assess the performance of the HR department as a whole, and others measure the impact of HR programs on the economic success of the organization. It is critical in HR to know what to measure and to remember that not everything that counts can be counted, and not everything that can be counted counts. One way to measure HR is to perform a human resource audit. A human resource audit evaluates the effectiveness of the human resource department by looking at how well the policies and programs sponsored by the human resource department meet the needs of the employees and the company. Most HR audits rely on the subjective judgments and candid feedback of line managers or the professional opinions of external experts. 3 of the most frequently recommended measures of human resource accounting include outlay cost, replacement cost, and human resource value. Outlay costs include the costs associated with recruiting, selecting, training, and developing employees. Replacement cost is an estimate of how much it would cost to replace existing human resources. Human resource value is the expected contribution to the firm's net income for individuals at each level of the firm. In the world of business, success is typically measured in dollar terms. We need to learn to calculate HR's value in terms of our financial contribution to the organization. Managers are usually surprised to discover the financial costs of employee problems such as absenteeism, tardiness, turnover, alcoholism, smoking, and grievances. Managers also tend to underestimate the financial contribution of HR activities such as training, career counseling, employee assistance programs, and test validation. A cost accounting framework has been developed by Wayne Cascio for assessing human resource costs. It provides formulas and examples for calculating the costs of turnover, absenteeism, sick leave, smoking, employee assistance programs, employee wellness programs, employee attitudes, wages, benefits, vacations, overtime, shift differentials, holiday, pension, and more. Understanding these calculations will change the way you are perceived by peer managers. Key performance indicators refer to specific measures of human resource activities that contribute importantly to the efficiency and effectiveness of a company. An example of an HR KPI might be training, where you can demonstrate how the training allowed employees or managers to do something more effectively or simply faster, which in turn will earn or save money. If it does not earn or save money, then there really is no need to do it more effectively or faster. There are 2 types of KPIs which tell a very different story about HR. A leading indicator is a measure that precedes, anticipates, or predicts future performance. A lagging indicator measures the results of a process or a change, such as sales, profits, or customer service levels. The process of collecting HR metrics and presenting them to managers in a useful format is referred to as an HR scorecard, or sometimes as an HR dashboard. More than 100 different metrics have been proposed for HR scorecards, and companies need to decide which metrics are their key performance indicators, their best measures of both efficiency and effectiveness. KPIs will not be the same for all companies or all industries. Here is a list of some of the most common performance indicators. However, if you can't show the value to the bottom line in expressing these to management, then they have no value. So be very careful with your analysis. You're going to look at things like revenue factor, revenue per labor cost, human capital ROI, human capital value added, HR expense factor, absence rate, turnover rate, cost per hire, turnover cost per employee, time to fill, training investment factor, healthcare cost per employee, employee benefits as a percent of payroll, HR to employee ratio. Numerous studies indicate that HR practices can and do contribute to the financial profitability of a firm. Research studies regarding the relationship between HR practices and firm performance conclude that employee involvement in decision-making, incentive compensation practices like profit sharing and gain sharing, training, and a constellation of high-performance practices contribute to the overall profitability of an organization. The balanced scorecard involves analyzing the performance of an organization from multiple perspectives. There are three important stakeholders: the stockholders, the customers, and the employees. The balanced scorecard involves analyzing the traditional HR measures concurrently with performance metrics, other perspectives, financial results, customer satisfaction, and internal business processes. Human resource outsourcing can be a cost-effective method for companies to operate because outside experts can use economies of scale to perform the HR functions more efficiently. They can use their expertise, technology, and stay abreast of new legal requirements. Not all HR functions are suitable for outsourcing. The development of new technologies has dramatically changed the way many HR practices are performed. Portals allow employees to manage their own benefits without relying on HR specialists. Communication devices allow employers to communicate with each employee in a variety of ways, and team members can work together in virtual teams from multiple places around the globe. New technology provides tremendous benefits that make HR activities much more efficient and convenient, but it also creates new problems that have to be managed. The benefits of the shared services model come from having standardized services for all business units that can be administered uniformly from a central service center. They can be provided in-house or outsourced. The biggest problem with employee communications is that employees fail to read them. Here are a few simple tips that might help. Use simple language that can be understood by all employees. Keep sentences short, normally less than 20 words. Keep discussion of each issue to less than 1 page. Use wide margins on all sides. Use a graphic whenever it contributes to the explanation. Keep the communication short. Handbooks, for example, should normally be less than 30 pages. Memos should begin with an executive summary that is less than 1 page. Additional information should only be added if it is needed. Bulletins need to have clearly worded headings to let employees know if they should read the subsequent sections. This concludes Unit 1, Part 1.